When stocks and bonds stop agreeing, someone's about to get wiped out. And history shows it's usually the person holding equities. I'm breaking down stock-bond divergence today, one of the most accurate recession predictors in market history. The crazy part, most investors have never heard of it. Let's start with a shocking stat. In the 16 months before the 2008 financial crisis, stocks and bonds moved in opposite directions 73% of the time. While the S&P 500 kept hitting new highs, bond yields were screaming danger. The people who understood that divergence got out. Everyone else lost everything. Here's the core mechanism you need to understand. Stocks represent growth expectations. Bonds represent safety and yield. When they agree, the market's unified. When they diverge, that's when smart money knows something dumb money hasn't figured out yet. Let me show you how this works historically. Pull back to 2006. The stock market was crushing it, up 15% that year. The S&P 500 was at all-time highs. But bond traders, the supposedly boring side of finance, were doing something interesting. Long-term treasury yields started falling while stock valuations climbed. That's backwards. If the economy's growing, bonds should yield more, not less. But bond traders were pricing in economic slowdown. They were right. By 2008, the stock market crashed 57% while bonds rallied hard. Now here's the pattern. This divergence doesn't happen overnight. It builds for months, and the wider it gets, the more violent the eventual correction. Fast forward to 2020. Different story, same signal. When COVID hit in March, stocks crashed, down 34% in weeks. But bonds, they actually rose. Investors flooded into safety. This divergence lasted about 4 weeks before stocks realized the Fed would print infinite money and the recovery would be V-shaped. By May, stocks and bonds were moving together again, up. The key difference, 2008 divergence meant economy breaking. 2020 divergence meant liquidity crisis. Both predicted violent moves, but in opposite directions. The signal wasn't the direction, it was the disagreement. So what actually causes this divergence? 3 factors, every time. First, inflation shock. Bond traders care about real returns, what yields actually buy you after inflation. If inflation spikes unexpectedly, bonds crater in price because the yield they offer isn't worth it anymore. Stocks initially rally on the idea that companies can pass costs to consumers. But eventually, stocks realize wages will rise, demand will fall, and margins compress. That's where the disagreement happens. Second, credit deterioration. When companies start failing, bond investors see default risk immediately. Bonds trade on credit quality. Stocks are slower to react. Retail traders still think growth story. Meanwhile, corporate bond yields are spreading wider, flashing warning signs. We saw this in 2022 when the Fed started tightening. Bonds collapsed first. Stocks kept going up until October when reality hit. Third, monetary policy reversal. This is huge right now. For 2 years, the Fed held rates near zero. Bonds and stocks agreed, easy money forever. Then in 2022, the Fed hiked rates 425 basis points. Bonds crashed immediately. They hate rate hikes. Stocks took months to accept it. That divergence lasted from March to October 2022. Anyone watching bond performance got out before the stock crash. Now let's connect this to what you're actually worried about. Inflation, tariffs, layoffs, housing, consumer prices. Inflation is the ultimate divergence trigger. Here's why. When inflation's transitory, stocks and bonds agree. Easy money is enough. But when inflation looks structural, bonds panic first. Bond traders price in, we need higher rates for longer. That crushes bond prices. Stocks resist this reality until earnings reports show margin compression. That gap between bond recognition and stock recognition is your window. Tariffs create the same dynamic. If tariffs raise input costs, inflation data spikes. Bonds react first. Yields rise as investors demand compensation. Stocks think, pass costs to consumers. Then earnings guidance comes in weak. Surprise, margins are compressed. Divergence happens. Layoffs are actually the inverse signal. Weak employment data makes bonds rally, safer, but stocks initially fall on demand concerns. When both fall together, that's not divergence, that's consensus recession. But the period where bonds are rallying while stocks refuse to fall, that's your divergence, and it's dangerous for stockholders. Housing shifts directly impact this. Rising rates kill housing, bonds react immediately by rallying, Stocks in home building crash, but broader stock indices resist. They think it's just a sector rotation. The divergence between bond performance, rallying, and equity performance, flat or down slightly, persists until contagion hits the financial sector. Consumer prices feed this loop constantly. Sticky inflation keeps bonds under pressure. When inflation stays elevated longer than expected, bonds price in prolonged tightening. Stocks resist believing demand will be that weak. The disagreement between these two biggest asset classes is your recession canary. So what does the divergence look like right now? We're seeing something interesting in 2024. Long-term Treasury yields have been falling while the S&P 500 hit new highs. That's a mild divergence, not extreme, but directional. Bond traders are pricing in either growth slowdown or Fed cuts. Stock traders are pricing in growth continuing. This disconnect is widening slightly each quarter. The 10-year yield around 4% versus the S&P at new highs suggests bond markets are more cautious than stock markets. That's the divergence pattern. If it widens to extreme levels, bonds down 10%, stocks up 15%, yields collapsing, that's your recession warning, typically 6 to 12 months ahead. How do you use this? First, watch the correlation. When 60-40 portfolios, stocks, bonds, start seeing bonds up while stocks down, or vice versa, that's your signal something's breaking. Second, track bond yields. When 10-year yields start falling while equity valuations remain high, bonds are voting recession while stocks are voting growth. That vote usually lasts 4 to 12 months before stocks agree with bonds. Third, monitor credit spreads. High-yield bond spreads widening while stock multiples stay elevated. Classic divergence. Bonds are pricing credit risk stocks haven't recognized. Fourth, compare performance weekly. When bonds outperform stocks by more than 2 to 3% cumulatively over a month, pay attention. Divergence is real. The historical accuracy here is stunning. From 1960 to 2023, every major recession was preceded by stock-bond divergence lasting 6+ months. Not all divergences became recessions. Some resolved by realignment. But every recession had the warning signal. Your job isn't to predict the recession. It's to notice when the two biggest market signals disagree, because someone's wrong. And when they resolve, the disagreement usually costs money. If you're watching inflation, tariffs, and layoffs like we do on this channel, stock-bond divergence is your translation layer. It tells you what the bond market thinks about all those factors combined. Start watching this today. Track your bond fund performance against your stock fund. When they stop moving together, pay attention. History says you should. If this market analysis helps you make better decisions, subscribe. We break down economic signals retail investors miss every